The big number, $6 billion worth of losses for short sellers in GameStop. Is there anything about those types of companies, GameStop, BlackBerry, AMC, that's got you a little bit worried about the current market environment?
Well, I mean, look, I think you are seeing a retail investor that is flexing its muscle and engaging in the markets in a way that it hasn't before. And you see this both on in the Robin Hood phenomenon, but now you're seeing it with kind of what's going on with some of these crushings of the shorts. Am I worried about it? I mean, look, there are some signs of froth, but that can take a while to play out. It's just something that we have to contend with as a professional investor, which is there's going to be more stock by stock volatility when you have different players in the market. And so it's our job, in order to, as stock pickers in the funds that do so, in order to try to pick the winners, avoid the losers. And this makes a little bit more volatility, but that's the name of the game.
As a portfolio manager, Steve, would you be more or less likely to get involved in these types of stocks given the trading action that you've seen, or is this one that you would stay away from?
Well, again, in my fund, we primarily are investing from a macro perspective, where we're taking our bets at the asset class level, the industry, the sector level, the country level. We don't really get into. I mean, we do pick individual stocks, but we do that with a quantitative model. So it's not an issue specifically for us. In terms of our investing teams, I think the ones that do focus on individual stocks at Federated Hermes, it's their job to look and see if there's an undue opportunity or risk. If there's a name that's been beaten down artificially and they want to jump in, fine. I think that represents an outsized opportunity. Likewise, if there's names that are overdone with a little bit of froth and they want to take the other side of that trade, I think that makes sense. Either way, you can't complain about it. You just have to deal with it.
All right, so maybe technical factors behind some of the trading action we've seen in those names. Let's talk about the fundamentals, because I know that you're focused on some of those as well. Fundamentally speaking, does the stock market right now deserve to be at the levels it's at right now? Absolutely.
You've got an economy that is leaving a recession. It is not only in recovery, but I think we'll find out this week when we get the Q4 GDP number that in half a year, we will have made up about 80% of what we lost during the pandemic in terms of economic activity. That's as V-shaped as recoveries come. And when you look at where the 10-year yield is, and when you look at where corporate spreads are, and you compare equities versus bonds, they are inexpensive on that measure. Now, that matters because you got to put your money somewhere. And so, by our count, if you look at the historical relationship between stock PEs and where the bond market is, we're trading about 5 turns less than where you normally would, meaning that the stock market has an ability, believe it or not, to get meaningfully more expensive from here. And we think it'll do that slowly over the course of the next year or so.
What's the key that investors need to focus on, or keys investors need to focus on for this earnings season, including this week, the busiest week of earnings season?
Look, I think the big story is that the last 3 earnings seasons, Q2, Q3, and now Q4 so far, of which we're about 15% of the way through, have collectively yielded the 3 most significant beats that we've ever recorded on the S&P 500, beats of 20+%. And that's important because it's getting us back to earnings growth. I think in this quarter, the consensus came in looking for earnings to be down about 9% year over year. That consensus has improved to down 5% year over year. I would not be surprised at all if it turns out that we show year-over-year earnings growth in the fourth quarter. I think that path back to growth is the story, and it's paving the way for what it is expected to be, 20% plus earnings growth in 2021. I think we're very much on track for that.
All right, 15 seconds left here. What's your favorite part of the market right now?
Value, cyclicals, and international equities, because they are value.
Shepard Smith here. Thanks for watching CNBC on YouTube.